Which is the better stock to buy, ChargePoint or Plug-in Power? Charging electric vehicles or the hydrogen and fuel cell specialist? Which one of these is the best stock to buy? I'm going to compare these two energy stocks on 4 different financial metrics, and at the end of the video I will answer which one is the better stock to buy. Now, of course, each of these companies have been experiencing robust revenue growth. Look at Plug-in Power exploding from 250 million in trailing 12-month revenue all the way up to 701 million in trailing 12-month revenue, signing up exciting partnerships with the likes of Walmart and more. Meanwhile, ChargePoint also showing explosive revenue growth in the trailing 12-month, going from around 200 million all the way up to 468 million with its land and expand strategy, landing new clients where they install charging stations and then expanding, trying to add more charging stations. Of course, these two companies are both expected to grow robustly for the next several years, maybe even for the next decade or more, as these alternative fuels and alternative charging increases in popularity, taking over legacy methods. The next metric I wanted to look at is cash flow from operations to sales over the trailing 12 months. Now, I know these are fast growing companies and I expect to see negative figures in this metric, but what I want to see is progress towards profitability. So it could be negative, but I want to see that negative decreasing over time, which I do see here for ChargePoint, right? It had investments going all the way down to negative 68% in cash flow from operations, but I've been seeing improvements for several consecutive quarters, and it's now up to its best ever metric figure in terms of cash flow from operations to sales at negative 57%. So it's negative, yes, but it's the best that it's ever been for this company, and it's growing, right? It's improving. I can't say the same for Plug Power. I'm not seeing the similar expansion or reduction, you could say, in terms of losses of cash flow from operations to trailing 12-month revenue. And so I like what I see from ChargePoint, not so much from Plug-in Power. I guess it's still in the expansion phase. It still requires a lot of capital up front to roll out this technology, and it's leading to bigger losses in terms of cash flow from operations. The next metric I wanted to compare these two on is operating profit margin over the trailing 12 months. And again, I expect to see negative numbers here because these companies are growing so fast and they are so early in their business cycle. They're still in the growth phase. But what I want to see again is improvement, progress. And I see it from both, right? If we look from here, Plug Power showing improvement in terms of operating profitability as it's increasing sales, and the same with ChargePoint. If we start from this point here, we're seeing improvement in terms of operating profit margin, although still negative, negative 73% versus negative 94%, and ChargePoint was also better in terms of cash flow from operations to sales compared to Plug-in Power. So finally, I wanted to look at valuation, and what I chose to use is the forward price to sales ratio. And looking at this metric, Plug Power is more expensive at 3.114 compared to ChargePoint at 2.88. So when deciding which one of these two is the better stock to buy, I'm looking at the metrics that I compared them on, and it looked like ChargePoint was better than Plug Power in terms of cash flow from operations to sales. ChargePoint was also better than Plug Power in terms of operating profit margin over the trailing 12 months. And ChargePoint is selling at a cheaper valuation than Plug Power. Now, Plug Power was better in revenue, right? It was growing revenue faster than ChargePoint, but I'm the type of investor, I prefer slower revenue growth if it comes with better cash flow from operations and better operating profitability metrics, or better evidence, better trends in those metrics, even if they are negative, right? Because when you're evaluating these types of young, up and coming growth stocks, growth companies, early in their investment cycles, early in their growth stage, you're going to see negative numbers. You're going to see a lot of negative numbers. But what you want to see is improvement. You want to see decreasing negative numbers as sales expand. And I saw more of that from ChargePoint. And so I'm willing, and I don't even have to pay a higher valuation for ChargePoint. It's actually selling at a lower price to sales compared to Plug Power. So for those reasons, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would choose, between these two, I would choose ChargePoint as the better stock to buy right now. All right, so that's all I've got for this video. I've hand selected a few other videos that I think you would enjoy that are popping up on your screen right now. So please click on one of those and I will see you over there. Thank you so much for watching.